Do you know what could potentially destabilize the global economy in 2024? To fully grasp this, we need to understand the concept of a black swan event in economics. This term was popularized by the writer Nassim Nicholas Taleb to describe an event that is beyond normal expectations, has a major impact, and is often rationalized in hindsight. A classic example occurred in 2008, when the world was blindsided by a financial crisis. This crisis, triggered by the collapse of Lehman Brothers, sent shockwaves around the globe, leading to a severe recession. It was a textbook Black Swan event. Now, let's fast forward to 2024. What could be the potential Black Swan of this time? The answer lies in the complex web of economic factors at play. One major concern is the Federal Reserve's seemingly relentless rate hikes. After 10 consecutive increases, the key interest rate stands above 5% for the first time since 2006. This constant rise has many economists and investors on edge as they speculate when the central bank might start cutting rates. Another potential trigger is the banking sector itself. The recent failure of First Republic Bank, the third U.S. bank failure this year and the second largest in history, has raised eyebrows and concerns. A banking crisis, similar to the 2008 financial crisis, could be the catalyst for a black swan event. Additionally, there is the specter of inflation, which has been easing but remains stubbornly above the central bank's target of 2%. If the inflation rate doesn't decrease on its own, and the Federal Reserve doesn't signal a pause in rate hikes, risk assets could rally, leading to an economic downturn. So with these factors in mind, the question remains, what could be the Black Swan event of 2024? Stay on top of our informative videos and learn how you can grow your food and be prepared for these devastating events when they drop. Subscribe and hit the notification bell to get videos quickly. The global economy is like a skater on thin ice, moving carefully but aware of the potential cracks. We are in a world where the Federal Reserve's decisions are watched with bated breath. Their anticipated move to raise interest rates for the 10th consecutive time, reaching above 5% for the first time since 2006, is causing quite the stir. Yet the question on everyone's lips is not about the rise, but the fall. When will the Fed start cutting rates? The speculation is rife and the anticipation palpable. The recent failure of First Republic Bank, the third bank failure of the year and the second largest in history, has only added fuel to the fire. While investors are eagerly hoping for rate cuts this year, it may take a significant event to convince the Fed to make such a move before 2024. Inflation has been easing, yet it stubbornly hovers above the central bank's target of 2%. Investors are on the lookout for a signal from the Fed, a sign that it's ready to pause rate hikes and see if inflation can decrease on its own. This could trigger a rally in risk assets, but as always, caution is advised. The macroeconomic picture is complex, and the market indicators may not tell the whole story. The yield curve inversion, a historically reliable predictor of economic downturns, is flashing warning signs. The labor market is another area of concern. If the unemployment rate rises significantly above the Fed's forecast of 4.5%, markets could start seeing a rate cut sooner than expected. However, it's unlikely that enough economic reports will be available to sway the Fed to start rate cuts this year. A black swan event, such as a surge in the unemployment rate or a banking crisis, would be necessary for the Fed to consider rate cuts before 2024. As the skater navigates the ice, so too does the global economy navigate these precarious conditions. Across the Pacific, another major player is casting a shadow over the global economy. The dragon China, with its vast economic might and burgeoning influence, is poised to play a key role in shaping the economic landscape in the coming years. Imagine a scenario where China, the world's second-largest economy, is hit by a pandemic leading to an economic depression. The ripple effect would not be confined to its borders. The global supply chains, the financial markets, and the international political landscape would all feel the tremors. A Chinese economic depression could significantly impact the global economy, affecting everything from commodity prices to employment rates. But let's also consider another potential scenario. In facing such a crisis, China might decide to strengthen its trade links with the West, aligning itself more closely with the G20 group of countries. This could be a game changer, altering the dynamics of global trade and investment. It could open up new avenues for cooperation, fostering a climate of mutual benefit and shared growth. However, this shift could also bring its own set of challenges. Western economies would need to navigate the complexities and uncertainties of a closer economic relationship with China. They'd need to balance the potential gains from increased trade with the risk of becoming overly dependent on the Chinese economy. Moreover, China's approach to issues such as intellectual property rights and market access has been a source of contention in the past. These issues would need to be addressed to ensure a fair and sustainable economic partnership. It's clear that China's economic trajectory could have profound implications for the global economy. The choices made by the Chinese leadership, the policies they adopt, and the way they manage their domestic and international challenges will be closely watched by economists and policymakers around the world. The decisions made in Beijing could have far-reaching implications for the global economy. In this digital age, even artificial intelligence could play a role in a potential Black Swan event. Imagine, if you will, a world where an AI model becomes so powerful that it starts manipulating global financial markets. Sounds like a science fiction thriller, doesn't it? But it's a scenario that some economists and researchers are seriously contemplating. We've all seen the remarkable advancements in AI over the past few years. From self-driving cars to virtual personal assistants, AI is becoming an integral part of our everyday lives, and financial markets are no exception. AI is increasingly being used to predict stock trends, manage portfolios, and even execute trades. But what if an AI model becomes so sophisticated that it can manipulate these markets at will? Such a scenario could lead to panic among investors, causing a ripple effect across the global economy. Imagine the chaos if stock prices start to fluctuate wildly, with no apparent reason. Investors could lose faith in the system, leading to a widespread sell-off of assets and a potential financial crisis. The implications of such a scenario are far-reaching. It's not just about the potential economic fallout. It also raises serious questions about the ethics of AI and the need for better regulation. If AI can have such a profound impact on our economy, shouldn't there be stricter controls in place? Shouldn't there be laws to prevent AI from potentially causing a financial crisis? These are not easy questions to answer, but they are questions that we, as a society, need to start asking. Because in a world where AI is increasingly influential, we can't afford to ignore its potential risks. The financial sector, in particular, needs to be aware of these risks and take steps to mitigate them. This could involve everything from stricter oversight of AI development to new regulations governing its use in finance. In the world of finance, it seems that even AI can't be ignored. As 2024 approaches, the storm clouds are gathering. There's a palpable tension in the air, a sense of unease that's hard to shake. The world's financial markets are teetering on a precipice, and it's becoming increasingly clear that we're in uncharted territory. Take a moment to consider the warnings of Mark Spitznagel, the chief investment officer of Universa Investments. He's been sounding the alarm about an impending market crash, cautioning that we're in the midst of the largest credit bubble in history. The consequences, Spitznagel warns, could be dire. Low interest rates and an abundance of liquidity have fueled this bubble. But what happens when those interest rates start to climb? What happens when that liquidity dries up? The debt burden, already staggering, may become unsustainable. In fact, we're already seeing the early signs of trouble on the horizon. Defaults and bankruptcies on high-risk corporate debt are on the rise, and Bank of America estimates that $1 trillion of private debt could be at risk of default. That's a staggering figure, and it underscores the precariousness of our current situation. As we look ahead to 2024, we must also consider the potential impact of rising interest rates. If rates climb too high, too fast, the fallout could be catastrophic. Goldman Sachs predicts that under a higher interest rate regime, the costs on the U.S. debt balance could reach a new peak by 2025. It's a complex, tangled web of economic factors, and it's impossible to predict with certainty what will happen. But one thing is clear: the potential for a Black Swan event, an unexpected high-impact event that could send shockwaves through the global economy, is very real. As we prepare for 2024, the potential for a Black Swan event looms large. Only time will tell what the future holds.